Picture this. You walk into a store today and buy a candy bar for $2.50. Next year, you return to buy the same candy bar and it costs $2.75. The year after that, $3. Most people accept this as normal, inevitable, just the way things work. But here's what doesn't add up. Every economic textbook explains inflation as temporary price adjustments that eventually stabilize, yet in over a century of recorded data, prices have never actually returned to previous levels once they've risen. This discussion is for educational and analytical purposes only and does not constitute financial advice. The candy bar that cost a quarter in 1970 now costs over $3. That's not a temporary adjustment that corrected itself. That's a permanent shift that compounded year after year, decade after decade. Even during periods economists call low inflation, prices continued climbing just at a slower pace. The mathematical reality is stark. Since 1913, when the Consumer Price Index began tracking prices systematically, deflation has occurred in only a handful of brief periods, most notably during the Great Depression and briefly during the 2008 financial crisis. In every other year, spanning more than a century, prices moved in one direction, up. This creates a contradiction that is rarely examined closely. We're told inflation is cyclical, that it rises and falls with economic conditions, that central banks can control it by adjusting interest rates and money supply. Yet the historical evidence shows something entirely different. A pattern of persistent compounding price increases that never fully reverse, regardless of economic cycles, policy interventions, or technological advances that should theoretically make goods cheaper to produce. Why does this matter? Because if inflation truly never goes away, then every financial decision you make, every dollar you save, every investment you consider, operates under different rules than most people assume. The difference between temporary price adjustments and permanent purchasing power erosion fundamentally changes how economies function, how wealth accumulates, and how entire societies plan for the future. If prices only move in one direction over time, then the conventional wisdom about saving, investing, and economic stability requires complete reconsideration. The implications extend far beyond individual finances. Governments base fiscal policy on inflation models that assume temporary disruptions will self-correct. Pension funds calculate future obligations using projections that depend on price stability eventually returning. Central banks set monetary policy believing they can engineer soft landings and controlled price adjustments. But if the underlying assumption is wrong, if inflation is actually a structurally persistent force, rather than a manageable economic variable, then these institutions are operating with fundamentally flawed models. Consider what this means for retirement planning. Traditional advice suggests saving money in low-risk accounts will preserve purchasing power over decades. But if $1 today buys significantly less than $1 next year, and significantly less than $1 in 10 years, then cash savings don't preserve wealth. They expose it to gradual erosion over time. The same logic applies to fixed income investments, pension payments, and any financial instrument that promises to return the same number of dollars in the future that you put in today. The contradiction becomes even more apparent when you examine the language economists use to describe price movements. They speak of inflation cooling, or moderating when it drops from 5% to 3% annually. But 3% inflation still means prices are rising. The candy bar still costs more next year than this year. The cooling isn't a return to previous prices, it's simply a slower rate of price increases becoming permanent. And the reason this hasn't been reflected in price yet is not what most people assume. The widely accepted narrative about inflation follows a familiar pattern. Economic disruptions create temporary imbalances between supply and demand. Central banks respond with monetary policy adjustments, markets adapt, prices stabilize, and normal conditions return. This framework has shaped economic thinking for generations and forms the basis for how institutions, governments, and individuals make long-term financial decisions. The timeline appears logical and reassuring. During the 1970s, oil embargoes and supply disruptions drove prices higher, but economists assured everyone this was temporary. The Federal Reserve raised interest rates aggressively, unemployment increased, and inflation eventually fell from double digits to more manageable levels. Crisis resolved, system restored. During the 2008 financial crisis, deflationary pressures emerged as demand collapsed and unemployment soared. Central banks responded with unprecedented monetary stimulus, quantitative easing programs, and near-zero interest rates. inflation returned to target levels, confirming that policy tools could manage price pressures in either direction. More recently, the COVID-19 pandemic disrupted global supply chains, while stimulus programs increased demand for goods. Inflation surged to levels not seen in decades. Central banks again raised interest rates, and inflation began declining from peak levels. The pattern seemed to confirm established economic theory. Shocks create temporary disruptions, policy responses restore balance, and price stability returns. If you're interested in understanding markets beyond headlines, this channel focuses on exactly that. Institutional behavior has reinforced this narrative. Major investment firms base asset allocation strategies on the assumption that inflation represents temporary deviations from long-term price stability. Pension funds use actuarial models that project future costs based on historical averages, assuming current price levels will remain roughly constant over decades. Insurance companies calculate premiums using similar assumptions about future claim costs and administrative expenses. Corporate planning follows the same logic. Companies budget for temporary cost increases during inflationary periods, expecting input prices to stabilize once economic conditions normalize. They view wage increases as necessary adjustments to retain talent during tight labor markets, not permanent structural changes to their cost base. Capital investment decisions assume that equipment purchased today will provide predictable returns based on current price relationships between inputs and outputs. Government fiscal policy operates under identical assumptions. Budget projections extend decades into the future using inflation adjustments that assume temporary price fluctuations around stable baseline levels. Social Security and Medicare trust fund calculations depend on these projections to estimate future obligations and required contribution levels. Public pension systems promise specific benefit payments based on similar long-term price stability assumptions. Capital markets have embraced this framework completely. Bond investors accept lower yields on Treasury securities because they believe the purchasing power of future interest payments and principal repayment will remain relatively stable. Stock valuations incorporate inflation expectations that assume temporary disruptions will resolve without permanent changes to underlying cost structures. Currency markets trade on the premise that central bank policies can maintain price stability over time, making exchange rates predictable based on relative inflation expectations between countries. This is the part most people understand. The part that actually changes the outcome comes next. The reassuring narrative about temporary disruptions and policy solutions rests on several assumptions that appear reasonable on the surface. First, that supply and demand imbalances can be corrected through market mechanisms and policy interventions. Second, that monetary policy tools provide central banks with sufficient control over price levels to engineer desired outcomes. Third, that economic systems naturally tend toward equilibrium states where price relationships remain stable over time. Each assumption seems supported by historical examples and theoretical models. Market economies do demonstrate remarkable adaptability in responding to shortages and surpluses. Central banks have successfully managed inflation expectations during numerous economic cycles. Long periods of relative price stability have occurred, particularly during the late 20th century, when inflation remained within narrow target ranges for extended periods. On the surface, everything still appeared to make sense. But beneath this familiar framework lies a different structure that operates according to different rules. The forces that drive persistent price increases don't respond to the same policy tools or market mechanisms that address temporary imbalances. They're built into the fundamental architecture of modern economic systems, embedded in ways that make them nearly impossible to reverse without dismantling the systems themselves. The structural forces driving persistent inflation operate through mechanisms that remain largely invisible to conventional economic analysis. Unlike temporary supply disruptions or demand surges that markets can eventually correct, these underlying pressures are embedded within the architecture of modern monetary and financial systems themselves. The first mechanism involves what economists call the ratchet effect, though they rarely acknowledge its full implications. When production costs increase due to any factor, whether supply chain disruptions, labor shortages, or commodity price spikes, businesses adjust their pricing upward to maintain margins. The critical insight is that these adjustments become permanent fixtures in their cost structure, even after the original disruption resolves. Consider a manufacturing company that faces a 20% increase in steel prices during a commodity boom. The company raises product prices to absorb the higher input costs. When steel prices eventually decline, The company doesn't automatically reduce product prices back to previous levels. Instead, management has discovered that customers accept the higher pricing. Competitors have made similar adjustments, and the company has grown accustomed to the improved margins. The new price level becomes the baseline for future increases. This pattern repeats across entire supply chains simultaneously. Steel producers, manufacturers, distributors, and retailers all make permanent adjustments that compound throughout the system. Each level of the supply chain experiences the same ratchet effect, creating layers of price increases that never fully reverse. What began as a temporary commodity price spike becomes embedded as permanent cost inflation throughout the economy. The monetary system amplifies this ratcheting through its fundamental structure. Central banks manage inflation by controlling the money supply, but their tools work asymmetrically. Increasing the money supply to stimulate economic activity happens quickly and easily. Reducing the money supply to combat inflation requires deliberately inducing economic pain through higher interest rates, reduced lending, and increased unemployment. This asymmetry creates a persistent bias toward monetary expansion over time. During recessions, central banks rapidly increase money supply to prevent economic collapse. During periods of growth, they gradually reduce accommodation, but rarely to levels that would actually shrink the total amount of money in circulation. Each economic cycle leaves the monetary base larger than before, providing the fuel for future price increases. Financial institutions reinforce these dynamics through their lending and investment practices. Banks create money through the lending process, and their incentives favor expanding credit rather than contracting it. Loan officers are rewarded for originating new loans, not for preventing monetary expansion. Bank executives face pressure to grow assets and earnings, which requires increasing the volume of credit extended to borrowers. The regulatory framework supports this expansion bias. Banking regulations require institutions to maintain specific capital ratios relative to their loan portfolios, but these requirements are designed to ensure solvency, not to limit monetary growth. Central bank policies provide backstops that reduce the risk banks face when extending credit, encouraging them to lend more aggressively than market forces alone would dictate. Corporate behavior has adapted to expect persistent inflation rather than fight it. Rather than viewing rising costs as temporary disruptions to be minimized, businesses build inflation expectations directly into their planning processes. Labor contracts include automatic cost of living adjustments. Supply agreements contain escalation clauses tied to inflation indices. Capital budgeting assumes that equipment and facilities will cost more in the future than they do today. This creates what economists call inflation expectations, becoming anchored at levels above zero. When everyone expects prices to rise, those expectations become self-fulfilling. Workers demand wage increases to maintain purchasing power. Businesses raise prices preemptively to cover expected cost increases. Investors bid up asset prices to hedge against currency debasement. The expectation of inflation generates the very price increases that confirm the expectation. Government fiscal policy adds another layer of structural bias toward rising prices. Public sector spending represents a significant portion of economic activity, and government purchases don't respond to market pricing signals the way private purchases do. When a city needs to build a bridge, it pays whatever the project costs regardless of whether those costs are reasonable by historical standards. When a federal agency needs to procure equipment, it accepts vendor pricing without the same margin pressure that private buyers would apply. Government employment follows similar patterns. Public sector wages tend to ratchet upward but rarely decline, even during economic downturns when private sector compensation might fall. Public pension obligations compound this effect by promising specific future payments regardless of economic conditions or the government's ability to fund those commitments without increasing taxes or expanding the monetary base. The global nature of modern economies creates additional persistence mechanisms that didn't exist when inflation theory was first developed. Supply chains span multiple countries with different monetary policies, labor costs, and regulatory environments. When inflation emerges in one major economy, it transmits through trade relationships to other economies, even those with more conservative monetary policies. Currency relationships amplify this transmission effect. When the United States expands its money supply, other countries face pressure to follow similar policies to prevent their currencies from strengthening to levels that would damage their export competitiveness. This creates synchronized monetary expansion across major economies, making it virtually impossible for any single country to maintain price stability while others are experiencing inflation. Technological advancement, which theoretically should reduce production costs and create deflationary pressure, instead gets absorbed by these structural forces. Improved productivity allows companies to maintain profit margins while absorbing higher costs for labor, materials, and regulatory compliance. Rather than passing productivity gains to consumers through lower prices, businesses use efficiency improvements to offset other cost increases while maintaining or increasing absolute price levels. The financial sector's evolution has created new mechanisms that channel monetary expansion directly into asset prices and consumer costs. Sophisticated credit markets allow consumers and businesses to borrow against future income and asset values, increasing current purchasing power beyond what current production would support. This expanded purchasing power bids up prices for goods, services, and assets, creating inflation that wouldn't occur in a system where spending was limited to current production. If this kind of structural analysis is useful to you, subscribing helps you stay ahead of the signals markets usually notice last. Asset financialization transforms goods that were once purchased outright into ongoing payment streams that can accommodate gradual price increases more easily than lump sum purchases. When cars, homes, and even everyday consumer goods are primarily accessed through financing arrangements, buyers become less sensitive to total purchase prices and more focused on monthly payment amounts. This allows sellers to raise prices gradually while keeping payments manageable through longer loan terms or lease arrangements. The insurance industry adds another layer of inflation persistence by pooling and distributing cost increases across large groups of participants. When healthcare costs rise, insurance companies don't negotiate them back down to previous levels. Instead, they adjust premiums to cover the higher costs while maintaining their profit margins. When property insurance claims increase due to weather events or construction cost inflation, insurers raise premiums rather than working to reduce underlying costs. Professional licensing and regulatory barriers prevent market competition from driving prices back down after they increase. When the cost of legal services rises, consumers can't easily substitute lower-cost alternatives because laws restrict who can provide legal advice. When healthcare costs increase, patients can't shop across state lines or access international providers due to regulatory restrictions. These barriers protect incumbent providers from price competition that might otherwise force costs back toward historical levels. Labour market dynamics have evolved to resist downward price adjustment in ways that didn't exist during earlier economic periods. Employment contracts, professional associations, and social expectations make it extremely difficult for wages to decline, even when economic conditions might justify lower compensation. This wage stickiness means that labour cost increases become permanent additions to business expense structures, regardless of subsequent changes in productivity or market conditions. The demographic transition occurring across developed economies creates structural demand pressures that persist regardless of monetary policy or economic cycles. Aging populations require more healthcare services, prescription medications, and specialized care facilities. These services are labor-intensive and difficult to make more efficient through technology, creating persistent cost pressures that monetary policy cannot address. These demographic pressures interact with political systems in ways that reinforce spending growth rather than cost control. Older voters participate in elections at higher rates than younger voters, and their preferences favour maintaining or expanding government programs that provide healthcare and retirement benefits. This political dynamic makes it extremely difficult for governments to control the fastest growing components of public spending, ensuring continued fiscal pressure that ultimately translates into monetary expansion and price increases. This is where the same forces that drove growth begin to reverse. The mechanisms that created persistent inflation during periods of economic expansion don't disappear when growth slows or reverses. Instead, they intensify the pressure on systems that have become dependent on continuous monetary expansion to function normally. Businesses that planned for perpetual cost increases find themselves unable to reduce prices when demand weakens because their cost structures have become permanently elevated. Financial institutions that expanded credit based on rising asset values face pressure when those values stop rising, but the loans they extended still require repayment at levels that assumed continued inflation. Government obligations that were manageable when economic growth could support expanding tax revenues become problematic when growth slows, but the commitments remain unchanged. Central banks face an impossible choice between allowing economic contraction to reduce inflationary pressures naturally, or maintaining monetary accommodation to prevent system-wide financial distress. The first option risks deflation and economic depression. The second option ensures that inflationary pressures persist even during periods of weak economic performance, creating stagflation, where prices continue rising despite economic stagnation. The global integration of financial systems means that these pressures cannot be contained within individual countries or regions. When major economies face this structural inflation persistence, the effects transmit through trade relationships, currency markets, and capital flows to economies that might otherwise maintain price stability. The system doesn't fail here, it tightens. Rather than resolving through market mechanisms or policy interventions, these structural forces create a narrowing range of possible outcomes. Economic policymakers find themselves managing increasingly complex trade-offs between financial stability and price stability, with fewer tools available to address both simultaneously. The comfortable assumption that inflation represents a temporary deviation from normal conditions gives way to recognition that persistent price increases may represent the new normal condition. Financial markets that priced assets based on assumptions about long-term price stability face gradual reassessment as evidence accumulates that those assumptions may be incorrect. This reassessment happens slowly and unevenly, creating opportunities for significant mispricing as different market participants adjust their models at different rates. The persistence of inflation reflects structural changes in how modern economies operate, not temporary policy mistakes or cyclical disruptions. Understanding these structural forces provides insight into why conventional economic models consistently underestimate inflation persistence, and why policy interventions designed to restore previous conditions may be addressing the wrong problem entirely. This is what remains unpriced for now. The candy bar tells the complete story. What cost 25 cents in 1970 costs $3 today, and it will cost more tomorrow. That progression hasn't paused, reversed, or corrected itself across more than 50 years of economic cycles, policy changes, and technological advances. The structural forces driving this persistence operate independently of the temporary disruptions that capture headlines and policy attention. These mechanisms remain largely invisible because they're embedded within systems that appear to function normally most of the time. Central banks adjust interest rates, markets respond to policy signals, and economic indicators move within expected ranges. Yet beneath this familiar activity, the ratchet effect continues turning prices upward through supply chains. The monetary system maintains its expansion bias, and financial institutions channel liquidity toward activities that bid up costs rather than reduce them. The mispricing isn't in individual assets or sectors, it's in the fundamental assumption that inflation represents temporary deviations from stable baseline conditions. Markets, institutions, and individuals make long-term decisions based on models that assume price relationships will eventually return to historical norms when the structural evidence suggests those norms have permanently shifted. Recognition of this structural persistence changes how systems respond to economic pressures. Rather than waiting for conditions to normalize, participants begin adjusting to accommodate ongoing price increases as a permanent feature of the environment. This adjustment process creates the very conditions that make inflation persistence self-reinforcing, transforming what began as structural bias into accepted reality. The transition happens gradually, then suddenly. Understanding these dynamics provides clarity about why conventional policy tools produce unexpected results, and why markets consistently underestimate inflation's staying power. The candy bar costs $3 today. Tomorrow it will cost more. Reality moves first. Price follows later. If this helped clarify how the system actually works, consider sharing it with someone who follows markets closely.